Morning, Chris.
Hey, what's up, man? Hi, Brian.
I'm good, man. This is Brian Jones. I'm here with Chris Hood, professional trader and world's most interesting man out there in the Canadian wilds.
Oh, man, the deep freeze. 13 of the world's coldest places are sitting in Canada today, and it's not mentioning my driveway. So I'm pretty surprised that it's colder somewhere else. This is terrible.
How much snow do you have up there right now?
I've still got these snowbanks from a couple of weeks ago. It's melted a little bit down to it's about 4 feet tall now. It was up to 6 feet. It's gone down to four, but my word, man, this is crazy.
Just like back home.
It's the coldest February I've had.
Just like back home in South Africa.
Oh yeah, absolutely. I mean, there's nothing like, a little bit of -40 just to keep you, in tune with things. I think the coldest I ever got to South Africa was around -2 or -3. But -2 at altitude is a lot colder than, -10, for example, here where you're not high up. So I don't know, man. Arthritis doesn't like the cold.
No,
that should be a new t-shirt.
So let's talk about Russia just a little bit. What do you think? This is on everyone's minds, and I mean, I know that you can't necessarily predict what's going to happen, but where do you see the market sentiment, and how this could potentially affect the market?
The market doesn't like uncertainty in any shape, way, or form, right? Positive or negative uncertainty. It doesn't like it, right? It just wants clarity. The thing with Russia, I mean, politics aside, I have no opinion on anything. I try not to spend my time watching hyperbole presented by the mainstream media. I just don't watch it. But the interesting thing out of this is Putin gave a lot of pre-warning about this, right? He annexed Crimea a couple of years ago. He's been talking about Ukraine as being part of Russia for years. In his university days, he wrote lots of papers around this stuff. And, yesterday's speech, I don't know if you saw it, but he literally sat, he was having a meeting with his security council. I saw this on CNN. And you have Putin on the far left of your screen, and it's zoomed out. And all of these security people that he has, these military guys, are all like, 100 feet away kind of thing. And the presenter was talking about, oh, maybe it's COVID distancing or something. And the analyst that they had on was, no, the guy's paranoid. He's completely paranoid about dying in his sleep or dying early. This is his life's goal. And, I think his parents were Ukrainian, or his mom was Ukrainian or something. And he's always seen the Ukraine as part of Russia. And it's pretty much culturally, part of Russia. And now with NATO coming in and saying, why don't you guys come and join this party? It's almost like this personal, it's a personal vendetta, right? Now, Russia is a major supplier of natural gas to Germany. And, Russia obviously earns money from the distribution of gas into Europe. So, here's one way to tighten the screws on Vladimir is stop buying his stuff. Now, all of this is going to have a positive effect on oil prices. What's Russia's biggest export is oil. So, you're going to turn off the bank accounts on one side, and you're going to open them up on the other side. You're going to take him out of the global payment system, which is, a pretty hard thing for the recipient of that kind of sanction, because now all of a sudden the domestic economy starts to stall because now you can't pay for foreign imports. I think it's going to create a lot of tension. But you know what? The thing is, the Russians, if there's one thing I'll tell you, is the Russians play a far harder game when it comes to this kind of stuff. Putin's a trained spy. He's not he's not your normal elected politician. This guy was a KGB operative, and he understands how the West thinks probably better than the West, right? And then, you put Putin against Biden, and I have to say, Vladimir Putin is a judo black belt. You got to give him some credit. I mean, so as it turns out into the markets, it's going to create this uncertainty, whichever way, right? Whichever way. Will it put more downward pressure on things? Yes. I think that there's going to be a little bit more downward pressure that we've got. But all of this was predicted before. We know that the market's been slightly overvalued. It's been trading at extensions. It bounced pretty hard from that January sell-off. And now we're just looking for catalysts, right? The market looks for these catalysts to push things down. Is the market going to drop just because of Russia? No. There's much bigger issues, right? There's the Fed, there's interest rates, there's inflation, there's all of those things coming in as well. So, it makes for interesting television. But for me personally, I try and stay away from it. I think making decisions based on interpretations of events is a very, very tricky thing, because you land up having a bias whenever we watch this news, right? And anxiety and nervousness and all of this stuff. One thing I'll say about mainstream media is they love selling the hardcore danger stories, right? They don't really sell the good stuff. So, it's a hard thing.
It would be boring. It would be boring if you just flipped on the television and like, hi, everything is just fine.
Yeah.
Yeah. Here's the story about rescuing a puppy dog.
Exactly. Our brains are conditioned to watch anxiety or war or stuff like that. We find war entertaining.
Yeah.
So
everyone if you notice, people just have this fascination with morbid things. If you're driving and there's a car accident, everyone's going to slow down, rubberneck, and like see if they can.
It's going to be, I think it's going to be tougher. It comes down to a point I made a couple of weeks ago about, if you want to avoid the big volatility, you can't hold positions overnight. Like that becomes one of the key things. In hyper volatile times, if you want to ignore the sort of overnight movements, don't hold anything overnight. Try and trade intraday. Start your positions in the morning, get out by the afternoon. It's easier said than done, because a lot of traders will hold positions over different periods, right? So you're going to have some traders that are going to have positions that have got expirations way out into the future. And you've got some guys who trade intraday only. They go to cash at the end of the day. I do a mix of both. And I trade the charts in front of me. I try not to have too much of a bias one way or the other. I don't really care if the market goes up or down. I think you have to be a trader that has this, maybe not just the skill, but the tools to allow you to go in both directions. And we've been in an upward market for the last couple of years. So a lot of retail traders only have one side of the toolkit, right? They only have, how to trade a long call, for example, how to trade in a rising market or strongly trending market. And the thing is, a lot of traders also rely on indicators and tools that work very well in strongly trending environments. So when we're strongly trending up or down, those indicators work really well. And when we start going a little bit sideways, those indicators tend not to do well. And knowing the difference between the two and when to use them, that's a skill and that's experience that helps you. So I think a lot of traders are going to suffer over the next couple of months, particularly retail and guys that haven't seen these kinds of markets before. But there are ways to go around it, right? It's a learning curve that has to be done. One of the ways to get around it is don't trade. Stay out of the market and sit on your hands and wait for the setups that work.
Do you think staying in a higher proportion of cash right now is a good idea?
Yeah, the problem with cash though is inflation kills it. So, cash temporarily is a good idea, but you still have to beat inflation. Remember, inflation is going to take away the purchasing power of your cash. So, it's a little bit of a 50-50, right? How long are you going to sit in that cash position? If you're a trader and you're sitting in it for a day and a half, makes no difference. Yeah, okay, that's a good idea. You minimize your volatility, but you also don't get any alpha. So you're not growing your money if you're sitting in cash. You're certainly protecting its purchasing power. But when you start looking at positions, where are the opportunities? Well, the opportunities are largely going to be in the energy complex for now. So XLE, ERX, and some of the better performing stocks within the energy space. Anything that's connected towards the inflation story. So anything on the commodity side is going to do well. We have seen a little bit of an improvement in money going into the staples sector. So Coca-Cola, those areas, they're starting to, look a little bit more attractive for some opportunities. But, tech getting hammered, Google, Amazon, all of those guys are getting kicked in the face. So you've just got to be careful about where you go and avoid the mentality of buying the dip. Like, I just wouldn't do it. Like, don't try and pick a bottom here. I see a lot of posts of people in social media where they go, oh, the S&P is going to go here. And then when it goes there, they go, see, I was right. And I go, you didn't know. It could have gone the other way. Like, no one knows where the market's going to go. What you should do, though, is just get into the mindset of it will go where it wants to go. And based on what it's going to do, I will trade what I see, not trade your opinion. No one cares what you think. No one cares what I think. If I see a chart that's got it's got my tools on and it's telling me it's going up, I'm going to trade it in that direction. I'm not going to trade it against the direction of what the data is saying. And a lot of people get sucked into that game. Oh, I watched on CNN that things were looking a little rough and the market's trending down. So maybe it's going to turn around and I'm going to trade it. Yeah,
there's a meme floating around. Have you seen that? But the trading meme, it's like I bought the dip and it just kept on dipping.
Yeah.
Too much of those.
It's a hard skill. And I was saying to my clients, you saw the mail that I sent out a couple of days ago. Don't try and do it. Like, rather save yourself the pain and just wait for the setup that's, designed to make you money, rather than, oh, I think I'm going to buy now. Well, if you buy now, it could carry on falling. And then, what are you going to do? So rather than trying to pick a bottom, don't pick a bottom. Wait for the trends to confirm direction and then trade in that confirmed direction. Don't try and say, oh, well, things are going to look a little different. No, it doesn't work. It's not worth it. Not now. We're not trending enough to call a bottom. When we're trending, you can call bottoms because you can see where support lines actually start coming into play. Right now, support lines are just getting kiboshed almost every day. So, you want to avoid that kind of mentality. I can show you on a different chart. Like, this is intraday, but effectively it's the same principle. It doesn't really matter whether you're trading longer periods or shorter periods. If you look up here, this could easily be the day chart, for example. But this is a 15-minute chart, and you can see we've got this red cloud that sits at the back. So, we had a signal back last week on the 17th, that was on Thursday, to start buying puts. And we've been trading those puts, we've been buying puts, we've been trading intraday on those puts for Thursday and Friday. We're still in this red band. Now we've got a signal here to buy calls, which is the green one. Now, I can't buy the calls until this red band disappears, and it's not going to disappear until we close above 436. So even if I get a bullish signal in a bearish trend, I can't trade it. Now, some people might trade every single signal that they have, but this doesn't make sense. Why would you trade a bullish signal in a bearish trend? Your likelihood of this just continuing to bleed to the downside is very high. So you look for confirmations, right? So here you can see we had a squeeze signal trigger on the 5-minute chart back inside a red volatility band. You can trade that because you're not going to be holding it for long. We're trading it from the bottom of the range or towards the bottom end to the top end of the range. And you can see that the exit signal happened in the green for that trade. Now we've got a short trigger that's happening. So
you're trading off the 5-minute chart. What's your hold time usually?
15, 20 minutes, 3 candles, 3 to 5 candles. I'm not going to try and hold it for a long time. I will be out of all of these positions by the end of the day. So you start off, I usually only trade from around 10 a.m. So I let the first 30 minutes get defined. From that definition, we understand the ranges. I can understand the ranges. I can see what the sentiment is looking like. And then you can trade the direction. So, here you've got a 3-minute chart and a 1-minute chart. And when all 3 of these line up, okay, and this lines up as well, then you've got a trade, right? So I can't really trade I trade the 15-minute chart, right? So I take my entries off the 15, but I need the 5, the 3, and the 1 to be validated. So they all need to be saying the same thing. And then I look up here at volatility. And when I see volatility, here we had our signals triggering a rise in volatility back here on Thursday. This is the 1-hour chart on volatility. That was perfect. Here, this is where you start buying your puts, because when volatility starts to rise, the S&P starts to go down. When we look at the put-call ratio down at the bottom here, this signal is very, very powerful, very, very powerful and very successful. So from here, it was telling us from the 16th of February. So this is going back nearly a week that we needed to be buying puts.
Is that the trend? Is that the trend? The put buy puts.
Yeah,
Which
so this basically looks at almost trend and sentiment always together. So if you start splitting this down into much more narrow timeframes, like shorter timeframes, you get too many signals.
Mm-hmm.
And that's the problem with a lot of indicators, is that if you're getting too many signals, you get indicatoritis. It's almost like, oh, which one do I use? Do I use this one? Do I use this one? Do I use this one? It becomes quite hard to trade because you land up going, yeah, I got a signal here, but not here. So I'm not going to do it. And then it turns out to be a winning setup. Oh, damn it. I missed it. With the put call ratio, the minute by minute changes in the put call ratio are not useful. It's not useful. What I'm looking for is major movements. And if you look very carefully here, we are right at the top. We are sitting at levels of extreme opportunity here. And the opportunity here is where this turns green, when that flips to the downside and it starts saying, you know what, we're going to get a relief rally. Remember what happens. Every time someone buys a put option, the market maker has to go and sell short the shares. That's how they hedge themselves, right? What happens when those put options start to unwind? When people start to sell those put options, those market makers need to buy back those shares. So if everyone is buying puts and the market makers are selling all these shares, at some point when we start to release these put options, the market's going to get a relief rally. That's what happens. That's the cycle, right? So right now, everyone's in puts. And we know that because the ratio is sitting up here at around 103 up here. This is really high. If you look at that green line and we just scroll across, you can see that it doesn't get to that level very often. It's not something that happens often, right? So a lot of people are nervous. A lot of people are scared. And what we're looking for is that signal. Once we get that signal, look at that reversal that happens. So it's a really, really powerful indicator telling us when something is shifting, when people start to sell those put options that they've bought, and the market makers now have to buy back those shares that they've shorted so that they can cover their position. That's when the trend starts to shift. So that's what we're waiting for, is we're waiting for this signal to turn green. So when that signal turns green, and it will be somewhere up here, that could rally us all the way back down here. So that could see a nice relief rally in the S&P, big opportunity, and then we'll get a red signal. And
so that's the daily chart. And which indicator are you?
This is the put call ratio on the hourly chart. And we've built a specific signal on two moving averages. These are not your normal moving averages. Two normal moving averages, two abnormal, should we say, less popular moving averages that give us a very strong win rate when it comes to actually the accuracy of those signals. So that's what we're looking for. We're looking for a reversal in the put call ratio from the top. And a lot of people will look at the put call ratio and go, it's meaningless. And I look at that and I go, there's probably 20 other signals that you could wait for. Probably, we wait for signals changing on volatility. We can look for signals changing on, everything else. I found when I trade, if I'm looking to trade a direction, all right, remember, when you're trading a call or a put, you're trading a direction first. That's the most important thing. You're trading in a particular way. This is one of the best and most accurate ways of determining changes in direction that you can have, is when sentiment at the fear factor level, all right, so where this is elevated fear, this is no fear at all, so this is fearless, fearful. I'm looking for when people go to become less fearful. And when that less fearful happens, what happens is the first people leave the party. You don't want to be the retail guy that's the last guy to leave this party. That's what you're trying to avoid. Is, I said to some clients the other day, is you don't want to be the trader that's that guy that just hangs around at a party and is last to leave. Like you've got to be careful not to have that kind of mentality. Don't be the last guy to leave the party. Always try to be the first.
That's like if you go out to eat with a big group of people and you wait too long, you end up paying for half the like everybody splits. Nobody splits the bill.
Nobody splits the bill. It's always the guy that's lost. Yeah,
6 guys, they're all gone. Yeah,
absolutely. That's a great way of looking at it, because everyone wants to be the guy that leaves first. And what you do is you order that expensive lobster starter. And
Your
we just
your
drop him
meal costs a
$5
lot
each.
because you're paying for all your friends too.
Hey guys, here's my contribution. It's $5. Only everyone's eating appetizers. It's cool, you know. Yeah, so that's what we're looking for, is a shift in sentiment. When we get that change, now there's nothing saying that we can't get a green signal here and then a red signal here and a reversal back to the upside. But the point of the matter is this: I'm not looking at CNN. I'm not looking at my interpretation of military movements at the border of an East European country to determine what direction I'm going to trade in. All right, I'm going to wait for the signals to tell me. So if we open up this morning and we break this red band and we're going up here, that's bullish, right? And as long as these remain in the green bands, I can trade calls. I can trade calls above that dotted black line and above this line here. I will trade calls this way. And if it falls back below this red line, I'm going to trade puts to the downside. So a lot of times people tend to trade emotionally, right? And this kind of setup, the way that you look at the data here, you take away that emotion. I just trade the signal. If the signal is bullish, I trade bullish. If it's bearish, I trade bearish. I've identified the options I want to trade, which are next week's expiry options at the money. You can easily start off doing this as a straddle. So you buy a call option at 434, you buy the put option at 434. And what you'll find is there'll be a cycle of price. It will go up, it will come down, it will go up, it will come down. And it largely follows the pattern on volatility, right? Goes up, comes down, goes up, comes down, goes up, comes down. So when you've got your call option in your plan, you can trade your call option on the downs and you trade your put option on the ups. As long as you know your strike that you want to use, how do you determine your strikes are always going to be based on these levels, right? Previous days open, previous days high. You could also look at your support and resistance lines as well. I try and use the previous day's numbers because prices tend to stay around those levels. And I trade those strikes and I go out a week so I don't have too much theta erosion. It's a little bit more pricey. It's not the best strategy. I would say that there are much better pricing strategies to follow. But for me, it's like, okay, I'm happy to have that kind of pricing. I buy 2 contracts. I sell one when it's up 100%. I leave the runner to continue. So it's a simple process. It's not complex. The hardest part about any trading system, it's the human, not the data. The data is the easy part. It's the human being that pushes the keys. That's the weakness in any trading system. So as long as I can be completely set and follow my signals as they print, it will be profitable. If I don't follow those signals and I start umming and ahhing and I start doubting, the accuracy of the signals, then you lose. It's pretty much as simple as that. And the skills that you develop on a day trading basis can be directly applied into your swing trading as well. So I'm just changing the time frames under which I'm going to trade. So yeah, it's really, really important to add that kind of skill, that faster skill into your toolkit as the markets become more volatile, because the opportunities on the swing side are going to be far less when there's volatility. Just when you think you're going in the right direction, off comes the axe, chops everything up, and then you're suffering a little. So again, it comes down to planning. It comes down to your signals. You have to test your signals. So one of the things that I do a lot of is back testing the accuracy of every single entry that we have. So when we have them, I can see, okay, here, if I'm trading a signal that's 42% accurate with a 1.3 profit factor, I can't just leave it. I can't just buy it and leave it. I have to trade the signal as I get it. So I know that it can have big moves, all right? So amplitude is measured here in profit factor, and my win rate is close enough to 50%, and my expected time frame of holding is 23 bars. So I know what to expect on that trade. I don't just buy and hope. I know that it's going to be fitting somewhere in there. So that's the way that we try and do it.
What I know that for a lot of your trades, you like an over 50% win rate and like a 1.3, 1.5% factor. Yeah. Do you have different criteria for day trading setups than for like longer term positional plays?
Yes, because on a day trading basis, you're going to get far more frequent trades, right? So here I'm looking at 366 trades over a 2-year period, right? So when you've got a lower frequency, you often have higher probability, and you've also got extended duration. What I'm looking for here is fast duration trades I can close within a day. So with that comes a lower probability of winning, which means I have to be better at managing the trade as opposed to just buying and letting it manage itself, so to speak. So here, if I've got a lower win rate, I try not to trade a strategy that's going to suffer if I'm wrong. So if I buy something out of the money, for example, I've got a much higher dependency on being correct than I have been on anything else, right? If I buy at the money or slightly in the money, I've got an opportunity to offset a lot of that vega that's going to be effective if I'm wrong, to actually withhold, hold some value in that option. So I don't really mind too much if I'm day trading and I've got a lower probability of winning. It just means if I'm trading a lower probability signal, I'm going to have to pick my option that I trade a lot more carefully. If I had an 80% win rate and a 29 profit factor on a day trade chart, I'd be very comfortable buying a 30 delta call option for tomorrow or for Wednesday. Yeah, tomorrow. As opposed to an in the money for next week, right? You would trade a little differently. So your win rates don't tell you not to trade. They just tell you how you should approach your trading. So you can't trade an 85% win rate trade the same way as you'd approach a 22% win rate trade. Very, very different. So yeah, I do prefer having higher probabilities like everyone, but I could, we could build a trade that has an 80% win rate, but only generates 6 trades every 2 years. So if you wanted to sit around for 2 years waiting for that signal to happen, it's not going to be generating enough trades for someone to be making a consistent living off, right? But it does happen. Those trades happen. So in our plans, what we would do is we would isolate the ones that have got these higher win rates, put an alert on that says, look, when that alert happens, when that setup is now real, all right, 80 win rate, an 85% win rate, 75 profit factor, send me a message to tell me that it's there, and then I will go and trade it.
So I guess if you have enough of those, if you have one that only prints like 6 or 8 times in a 2-year span, but you have it on 20 different underlyings, then you'll have
you can make a lot of money. Yeah, for sure. A lot of our clients do that. What they do is they build, we've got about 80 to 100 setups that are shared. And what the clients do is they just take those setups, build the alerts into their system so that they know that they've got the repeating message that will come in when that setup is valid, and they walk away. There's no need to sit in front of your screen all the time if you've got an alert set up based on the setup you want to trade, because when that setup happens, it will ping you a message and you go in and you say, okay, yes, I like what's happening, I'm going to do the trade. So what happens then is the mindset shifts. When you're a day trader or you're a trader, sometimes you force an opportunity. Sometimes you're looking at the screen and you're going, oh, I really want there to be a trade because I need to trade, right? You have this need. If you don't need to trade, rather let your system do the hard lifting for you, which is find the opportunity that you want. And when that opportunity presents itself, then you're going to trade it. Don't try and force the opportunity onto your chart when it doesn't exist. And that's a big mental step for a lot of people, is to avoid forcing trades. Forcing trades and pretending that they're there because you need to trade, massive psychological disadvantage. So
people seem to find what they're looking for if they look hard enough. You can find a reason, or you can justify pretty much anything. So
yeah, absolutely. If you're a trader and you prefer a particular strategy, for example, your brain will trick you into believing that there's a setup for that strategy on every chart you have. So if you don't have a bias, right? So let's say you only know how to trade one strategy and you've got a chart in front of you, you're always going to look at that one chart, or you're going to look at your charts with that one strategy in your mind. And you will look and see things that don't exist. You'll see setups that don't exist. You'll see whatever, we've built templates for every strategy that we have. If I start off saying, you know what, I need to do a long call, for example, I have a setting just for long calls. And I can only trade long calls if this setting works, right? If this setting is giving it to me. So I can look at any of my 20 stocks that I like to trade. And if none of them have got that setting for the long call, I just don't trade the long call. Maybe a separate strategy would work. Maybe a long put, I've got the same thing for long puts. I've got the same thing for everything. So, if you want to trade a put spread, for example, there's certain range elements that need to be taken into account. You cannot do a put spread under the same setup conditions as a long call. They don't work the same. The setup is not the same. So it's important to make sure that you've got that as a trader. You have to know how your strategy, together with your indicators and your triggers, work together. Not every trigger triggers the same trade. Like it doesn't work like that. So it can be a pretty difficult learn for a lot of people. When they're only using maybe one setup. Let's say they're using a very traditional setup that's a lagging indicator that works in highly trending markets, for example, and then all of a sudden the market loses its trend. That setup, that trigger that you were using is no longer valid. And if you continue to use it, your win rate starts to drop a lot because you're using the wrong way. You're identifying the opportunities with the wrong tools. Not everything can be used with a hammer. You've got to build a house with a number of things. So it's a very interesting part of the sort of learn of trading, is realizing what tools work where and how often they work and with what. And what we found in our research was not all setups work the same. You can't take a setup that works generically with, say, one stock and apply it to another with the same degree of success. It doesn't work like that. And knowing up front which signals work on what stocks, with what frequency, with what with what degree of success in the past, I think is 90% of the game. If you knew that a stock trade at this, a particular setup worked 80% of the time at a profit factor of 14, so it was very profitable when it happens. It's happened a lot over the last couple of years. Wouldn't you be more interested to wait for that setup than try and force something into something that you don't even know if it's been successful before? That's the type of thinking that I try and teach people, is rather know up front and have your expectations managed, then assume it's going to work. And then when it fails, you go, oh man, I'm a terrible trader. No, you might be the world's best trader, just trading a really crappy setup. And knowing that difference is really important, because your mindset is going to affect you as well. So if you're constantly beating yourself up because you're losing, it might not be you. It just might be your setup that's wrong. So trade the setup that's going to work, not, don't have the assumption that everything's going to work the same.
From a psychological standpoint, I think it's interesting to read some of these books about these top traders and how most of them have blown up their accounts multiple times, in the rise. If those like Market Wizards and those other books, it's useful to know that just a lot of multimillionaires and billionaires are there despite their early losses. And
the thing with losing is no trader has ever not lost, and too many people try to trade without losing. So if you try and trade, it's like in jiu-jitsu. You go to jiu-jitsu, if you think you're going to have a career in jiu-jitsu from white belt to black belt and never tap, that's just ridiculous to even think that. Why do people think that when they come to trading? I don't think blowing up your account, though, should be a rite of passage to success.
Right.
I don't think you need to blow your account up to learn. I think there are faster ways and better ways to learn than losing a lot of money. And quite honestly, every single trader I've ever worked with, myself included, have blown up their accounts. I've blown up my accounts before. And the reason is because when you learn trading, your emotions are not taught. Trading is often taught as a very technical skill. It's price hits here, you buy this, then you sell here, then you do this, then you do. It's taught in a very mechanical way. The problem is trading is not mechanical, because it's only mechanical if you're using a trading robot. So by the way, my crypto trading robot that I built is now active, right? So that's a robot, that's mechanical. It doesn't get affected by the politics or the emotions of the day, right? You as a day trader, as a human being, as a retail client, you are an emotional individual trying to implement a mechanical skill. You've got no one to teach you how to deal with those emotions, right? So if someone says to you, it's simple, you buy here, you sell here, you buy here, you sell here. Yeah, it's not as simple as that, because your greed takes over, your fear takes over. Those are the things that will screw up. Every single trading plan that I've seen has been affected by greed or a fear. So you have to build a process that allows you to stay with your system. Because I'll tell you now, your brain will find ways to screw up every single good system you've got. That's just the way it is. Your brain works like that.
I believe that.
What's that?
I believe that.
Yeah.
I believe
So
that.
when you're trading, and when depending on what cycle you're using, you have to build confidence in your tools. So how do you stop yourself from overwriting your tools or overriding your tools? Is develop confidence with them. So how do you do it? You develop a signal pattern, and from there you day trade this or paper trade this for the next 30 days and monitor your success. Where did you get panicky? Where did you lose faith? Where did you start questioning your system? Those are the things you need to journal, and you'll see the scenarios under which your brain takes over tend to be pretty consistent. It's the same thing. I watched CNN. They said that there were bombs going over the Ukraine. So I closed my position in oil, like something like that. You've got to get to that point where you can trust your system implicitly. All right. And many people just don't. It's just that simple. No matter how much work they do, no matter how accurate the data is, they always think that they can get an extra 5%, an extra 10%. They don't take their profits. We had this scenario last week. We did that trade on Freeport McMoran. It was a one-day trade. We got that 200%er. And when I asked the subscribers, I was like, let me do a quick survey. Who did the trade? Who got in? Some guys did half. Some guys did the full trade. Some guys got out at 200. Some guys held on for 300 and lost money. So, you can have one great trade. People will react differently to it. You've got to develop that confidence to be able to trade correctly. And that's how you do it. It's not easy. This is a very rewarding job, but it's also one of the most difficult you'll ever have. So, it comes down to managing yourself. If you can manage yourself and you can stick with your plan, you'll be okay. So I wish everyone the best
positive
luck.
Note to end on in this market. So let's just stay safe, right, Chris?
Absolutely. Don't travel to Belarus, apparently. That's what they've told us not to do. Damn, there goes my holiday. It's a wild market, and it's going to get wilder. There's a lot of ways to look at this market. You can look at this market, you can go cower away in a bunker somewhere and wait for it all to pass, or you can face up to it and say, you know what, there's opportunity. I'll tell you now, there are more opportunities in this market than we think of. But if your tools are not designed to help you spot them, you're just going to experience bad stuff. So, check out the products that we have at Alpha Hunters, at rogueinvesting.com. And, if people want to get in touch with me, they can do it through the comment section. There's a lot of ways to solve the problems, right? It's just a question of doing it right. That's the key.
Good words of advice, Chris. And I will, got some kind of weird pop-up on my screen. Hang on.
You need to stop clicking on those gambling sites, Brian.
I don't know what to, it's weird. I got this thing that keeps popping up telling me it's raining. I'm like, thank you.
It's the hackers.
There it goes again. Okay, anyway. All right, Chris. Well,
coming.
if I can get this thing down, I can't even see the button. All right. Take care, man. Have a good one.
I'll see you next Tuesday. Take it easy, Brian. Good luck, everyone.
All right, see you, Chris.
Cheers.